So we are looking at IFRS 5, non-current assets held for sale and discontinued operation. Non-current assets held for discontinued operation. All right, so this standard deals with the accounting treatment of this standard deals with accounting treatment of assets that are held for sale. Okay, held for sale, or asset that we intend to sell. Okay, the accounting treatment of assets we intend to sell. All right, so a company may have assets, different types of assets for use in the business. The company can have assets such as vehicles, equipment, um, machinery, furniture, and so on and so forth. Okay, these are non-current assets. Now, they may come a point in time that the company may want to sell some of the assets, and there are various reasons for selling an asset. Yeah, maybe the company feels the assets probably has exceeded its useful life, so they want to sell it, or maybe they want to sell the asset and buy a new one. Okay, or maybe they feel they need they have liquidity challenges, so they want to sell the assets to able to boost their liquidity. And so there are several reasons why companies may want to sell their assets. Okay. Now, assuming this company want to sell their one of their vehicles, maybe it's a truck. They want to sell one of their trucks. So this is the truck they want to sell. Okay, so this is a very big truck. All right. Now, first they need to get the selling price. They need to know how much they are going to sell the car for, or the truck for. Then they need to identify a buyer. Okay, they need to identify a buyer. They sometimes they need to do do an advert. Okay, they have to advertise the sale so that they can get uh, buyers. Okay, and sometimes they need to do valuation of the assets. They have to value the asset to know the market value at the time of sale of the assets. Okay. So all these exercises, I mean, the company has to do them, okay, when they want to sell the assets. Now, if the company decides to sell the assets, usually they cannot sell it out like outright or immediately, because sometimes it takes a while to locate a buyer. They have to look for a buyer and all that, and sometimes a while. It can take a while to locate. It can take maybe 2 months to get a buyer, or maybe 3 months to get a buyer, or 4 months, to get a buyer. So during the period that the car or the assets, the company is waiting for a buyer. how do they treat this track or this asset in their records? So that is what this standard is about. Okay, how do we account for asset that we are waiting to sell? Okay, we are ready to sell the asset, but the only thing is we don't have a buyer yet. We are waiting for a buyer. So the moment, the period that we are waiting for a buyer, how do we treat this asset? Should we treat it as a normal, like any of the assets we have, or should we treat it differently? Okay, differently because it has a different purpose. So what do you think? Such an asset, should we treat it just like the other assets we have, or we should treat it differently? Anyone
So
to help us?
I think we have to treat it differently.
Hello?
Hello, sir, can you hear me?
Yeah, I can hear you.
So I was saying that I think we have to treat it differently.
Yeah, we have to treat it differently, correct. Yeah, because they have a special um use, because we are going to sell it.
Yes.
We are not going to maintain it in the business. All right. So if we take our assets, if this is a set of our assets, all these are maybe we have A, B, C. Uh, okay, and this one we want to sell it. All the rest we are maintaining it. Okay, A, B, C, D, A, B, C, D, E, F. Okay, but we want to sell this one. Okay, so this one we want to sell it. We have to treat it differently from the rest. Okay, and how are we going to treat it? And that is what the standard is saying. That's what the standard provide guidance on how we should treat it. So before the decision to sell the asset, this asset is under non-current assets. Let's say this box is a set of all our non-current assets. Okay, non-current assets. Now, once we decide to sell this asset, it has to move from this box because it's no longer part of this set, and it must come to a new box. We have to move it from here to here, here to here, and this box is current assets. Okay. Now, why do we move it from non-current to current? That's another question we have to ask ourselves. The standard says if you want to sell a non-current asset, we have to move it from non-current category and add it to the current asset. The reason is because this asset is expected to be sold within a short period. Like we expect to realize it within a short period. Therefore, it doesn't qualify as non-current. So non-current assets are assets that we expect to use for more than a year, and that's what we expect to maintain it for more than a year. But since this asset we expect to sell it within a year, we have to classify it as current assets. So that's one of the key principle under IFRS 5. Okay, that's assets that are held for sale are classified under current assets. That's one of the key principles that we have to bear in mind. Another key principle is that since once the asset is held for sale, it means we are just assuming that we are selling this track. Okay, we will ideally we will park it somewhere and wait for a buyer to come to buy. We are not going to be using the asset. We just park it neatly, wait for a buyer to come. So because we are not using the asset during the period that we are waiting for a buyer, during the period we are waiting for a buyer, we are not using the asset. We don't depreciate the asset. Okay, so assets held for sale are not depreciated. So that's another important principle we have to note. They are not depreciated because we are not using it. We are just parking it, waiting for a buyer to come and buy the assets. Do you get it? Okay. Now let's look at another important principle. Now, when the asset was under non-current assets, like when the asset was originally under non-current assets, okay, we were using, let's say, we were using the cost model. So it means the this asset has a carrying amount, okay, which is the cost minus accumulated depreciation. Now, if we move this asset to here, are we going to use the same, assuming this asset carrying amount is 2,000? When it was under non when it was under non-current assets. When we move it to current assets, are we going to use the same 2,000 to be its current amount, or we are going to use a different figure? That's another question we have to ask ourselves. What do you think? So under non-current is the current amount. So when we move it to held for sale, are we going to use the same figure, or we are going to use a different figure as the current amount? Okay.
What I say?
Hi. Yes. Yeah. Even.
Uh, okay, so I thought you were asking a question.
Ah, yeah. Yeah. I was asking a question. Yes. Yes.
So can I try?
Yes. You can. Yes. You can. You can.
Okay, so I think we will not use the carrying amount as
Okay.
the new value to me the new uh, because of the new repairs, or let me say renovations that have been done to it. I think it may be at the revalued amount because it is ready for sale.
Okay.
So it may use the revalue amount. That's my mind, according to my mind.
Yeah. 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 You are close. Yes. You are not far from the truth. You are close to the truth.
Hmm.
Yeah. So, when we decide to sell an asset, okay, first of all, we have to put a price on it because now it's going out to the market. uh All right, it's going out to the market. So we have to use, like you said, the revalued amount. Yeah, we have to use what we call the fair value. Okay, the fair value of the assets. Okay, the fair value of the assets to be the, like, to in a way to be like the carrying amount. All right, but that is not the end. So the standard actually says that to determine the value of this asset under its new status, which is held for sale, first we need to know the carrying amount. The carrying amount when it was under non-current assets. Okay, maybe the carrying amount was 2,000. Then we need to know the fair value less cost to sell. Fair value less cost to sell. Less cost to sell. Okay, the fair value is like the market price, or the market value, and the cost to sell is, before you sell an asset, you have to incur some costs like advertisements. So if let's say the fair value is 2,000, and you have to advertise, do some form of publicity, maybe it's 500 cedis. Then it means your net proceed or your net value is 1,500. So this is what we call the fair value less cost to sell. So if the fair value less cost to sell is 1,500, okay, the standard say we should use the lower figure as the new current amount of the asset. Now the question is, why are we using the lower, not the higher? Anyone? Okay, so let's see the reason why the standard is saying we should use the lower. So it's all about impairment. Okay, it's all about impairment. Whether the value we are quoting is a correct value. Okay, so let's look at this. We are saying the current amount of this car is 2,000. Of this truck is 2,000. Okay, fine. This is what is in our books. But when we sell it, or the fair value let's cost to sell is 1,500. It means when we sell it, we cannot get this 2,000 we have stated in our books. We can only get the 1,500. Okay, so it means the true value of this asset is the 1,500. I hope you agree with me. Do you agree?
Yes, sir.
uh Because if we sell it, this is what we will get, which is not which is different from the carrying amount. So the best value is the 1,005. Okay, now let's look at another scenario. Let's say the carrying amount is 1,500. Okay, let's just change the positions. The carrying amount is 1,500. The fair value is the fair value less cost to sell is 2,000. Okay, now which one will you pick? Okay, so now we are saying that, oh, okay, the current amount is 1,005. That's what we have in our books. But when we sell it, we'll get more. Like we'll get more than what's the name, what we have as a current amount. So it means that this current amount of 1,500, all right, we have even let me say um we have even lowered the value down. We have brought the value down, which means if we sell it, we are going to get a profit of what
500.
500.
Yes.
Yeah, because we are saying okay, the value is this, but when we sell, we are even getting more than this. uh So in that case, we will maintain the current amount, which is the law, because we will not make a loss if we sell it. Do you get it? We will not make a loss if we will even make a profit. So we have to
Yes.
maintain the current amount. So these are the dynamics. Here, the first example, if we use the current amount, when we sell it, we will get less than what the current amount is. So which is not correct. So it's better to use the fair value less cost to sell. But in the second scenario, the fair value is more than the current amount. So it means we are safe. I mean, it's safe because when we sell it, we'll even get more, we'll get some surplus. So we will maintain this 1,500. So the standard says that assets held for sale are carried at the lower of the carrying amount, okay, and the fair value less cost to sell. And that's what the standard says. So if you classify an asset as held for sale, you use the lower of the carrying amount and the fair value less cost to sell. So you have to determine these two figures and pick the lower of the two. Yeah. So that's all about. IFRS 5. Okay, but let's go into some of the theories or some of the principles. Okay. So the standard says that an asset should be classified as held for sale if its carrying amount will be recovered principally through a sale transaction. So the key word here is what sale
Sanction.
transaction. If we will sell the assets, okay, if we are going to what sell the assets, okay, rather than continue use. Do you get it? Yeah. So any asset that we intend to sell, okay, we have to what, classify, which is a non-current asset. We have to classify it as held for sale. And there are certain conditions. The condition is that the assets in question should be available for immediate sale. Okay, the key word here is immediate. Immediate sale. You have to always remember. If you intend to sell an asset and you are not ready to sell it immediately, it means you are not ready. You are not yet ready to sell the asset, so you cannot classify it as held for sale. So before you classify an asset as held for sale, it means you have done all your homework and the asset is ready for immediate sale. Immediate sale. Do you get it? Asset is ready for immediate sale. Okay. And the sale must be highly probable. Highly probable means that, I mean, management have made a decision that to sell the assets. That there's a high chance that the assets will be sold than not to be sold. Okay. Now let's what does the standard says about high probability of sale? If they say the asset is highly probable to be sold, what does it mean? It means that one, it means that management are committed to a plan. It means that management is committed to a plan to sell the assets and an active program has been initiated to locate a buyer. So the key word here is locate a buyer. So management are ready to find a buyer to. So if you are not, if you have not even started to look for a buyer, then you cannot classify the asset as held for sale. Number two, the asset is being actively marketed at a sale price that is reasonable in relation to its current value. So you are selling the asset at a fair price, not any unreasonable price. You are selling the asset at a fair price. And C, a completed sale is expected within 1 year of classification. So we expect to sell the asset within a year, according to the standard. Okay. Number D, it is unlikely there will be any significant changes to the plan or the plan will be withdrawn. So it's saying that we are not going to change our minds on selling the asset. Once we have decided to sell the asset, we are not going back. Okay. So when these conditions are satisfied, then we can classify the asset as held for sale. So if any of these conditions are not satisfied, then we cannot classify the asset as held for sale. Okay. So you need to remember these points very well. So the key,
So,
the
so
yes,
you mean even if one of the four conditions is absent,
yes. If any of them is not met, if any of the conditions,
so
mhm,
so likely three is available, only one that is absent. We still can classify.
yes, yes, according to the standard,
Okay,
yeah.
all right.
So the bottom, all this is trying to talk about the readiness of the company to sell the assets and the commitment of the company. If any of them is out, if any of them is not met, then in a way they are not ready to sell the assets. If, for instance, number one, if they are not looking for a buyer, they have not started looking for a buyer, and then we cannot even tell whether they will. uh And number two, if they are selling the vehicle at, sorry, if they are selling the assets at probably at an outrageous price, then they are not, it means it may take longer to even find a buyer, or they may not find a buyer at all. Eh, And if they don't intend to sell the asset within a year, you see, if they don't intend to sell the asset within a year, it means they are not ready to what, sell the asset. So all of them must be met before they can uh, classify the asset as held for sale. Okay. So so this classification also applies to disposal groups. So it's not only group refers to a group of assets that are to be disposed. Okay. So for instance, a company has a branch. A branch can be a disposal group. Like the company can decide to sell the whole branch. Yeah. A branch can have computers, furniture, equipment. So if the company is selling the whole branch, like they are selling all the assets in the branch, so the branch becomes a disposal group. So a disposal group refers to a group of assets to be disposed of. So an individual asset, maybe like one asset, can be classified as held for sale. A group of assets can also be classified as held for sale. Okay. Okay, let's look at a simple illustration here and see whether we can classify the asset as held for sale. Company A is committed to a plan to sell its headquarters building and has initiated an active program to find a buyer and complete the plan. The building is being marketed at a reasonable price. So that's one condition here, reasonable price. And a completed sale is expected within 12 months. Another co- um, condition here. It is unlikely that this plan will change significantly. Okay. The company will not actually vacate the building until a buyer is found. Okay. So you are saying the company will be in the building until the buyer is found. But then the time taken to vacate the building will not exceed what is regarded as usual and customary for such buildings. So, can we classify this asset as held for sale? Are they ready to sell the asset?
That they are not ready, despite all the conditions available. But
Mhm.
still, it means they are not ready. Meaning, they continue to use it means they will have to calculate depreciation.
Yeah, that's a good point. So, looking at, the conditions here, okay, they have met the reasonable price. with 2 years, it is unlikely this plan will change. Like they are not going to change the plan. But here, that's where the problem is. The company will not actually vacate the building until a buyer is found. Okay, so that's the issue here. But there's a further reason for that. Reason why, I mean, a further explanation to this. Okay, they say, but then the time taken to vacate the building will not exceed what is regarded as usual or customary for such buildings. So, strictly speaking, this asset is not ready for to be sold because they are still, I mean, they are still using it. But they are also saying that okay, in case a buyer comes, they can easily vacate the building, like within I mean a short period or an acceptable period. Okay, so because of this statement, okay, because of this, what this statement, we can say that they are ready to they can classify it as held for sale. uh Yeah, even though they are using it, but the asset is available for immediate sale, which is if a buyer comes, they can vacate the building and sell it. And the time it will take to vacate the building, the question say it's a usual period, like it's not any time that is it's not an unusual time. Okay. So let's look at this example coming from the standard itself. So let's look at what the standard says on this um issue. It says, strictly speaking, okay, the building is not immediately available since it will take time for the company to move out once a buyer is found. So if we look at this strictly, we can say the building is not ready for sale. Well, that is correct. But let's continue. However, the time taking will be usual and customary. So this is what is making the difference. The time taken will be usual and customary. Furthermore, all of the other criteria for classification as held for sale are satisfied. Okay, therefore, the building should be classified as held for sale. Okay, so that is the dynamics. Okay, okay, let's look at example 2. So we have a company B. Company B is also committed to a plan to sell its headquarters building and is in precisely the same situation as Company A, except that it will not vacate the building and transfer it to a buyer until a new headquarters building has been constructed. Okay, so Company B also is in a
It,
precise situation. So, what is your take on Company B?
so this one there, we shouldn't even
We shouldn't even think of
we
classify.
shouldn't even make an attempt. It's an offense.
It's an, it's an offense. Yes, this
Yes,
is
so they are lacking that condition for immediate,
yes, yes,
that
yes,
immediate condition.
yes, 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 yes. They are lack. Yeah, you are right. They are lacking it because if they are to construct a new headquarters before they vacate, you can imagine when they will finish that new headquarters. I mean, they are not ready at all. Okay, so let's look at the solution. The building is not available for immediate sale, like you said, immediate sale, since the sale cannot be completed until a new headquarters building has been constructed. This building should not be classified as held for sale. So is this because they have to construct a new office building, they cannot classify it as held for sale. Okay, now let's look at measurement of non-current assets held for sale. That's what we were trying to do initially. So the standard says non-current assets held for sale should be measured at the lower, the keyword here is lower of its carrying amount when it was initially classified as held for sale and its fair value less cost to sell. Mm, its fair value less cost to sell. Okay, okay. Now, if the carrying amount of the asset is more than its fair value, so if the carrying amount of the asset is maybe 3,000, the fair value is the fair value less cost to sell is um 2,000. So we'll pick the lower, which is 2,000. And the difference of 1,000 is what? Impairment. It should be treated as what? Impairment. Why are we treating it as impairment? Because we are saying that the current amount is a value we have placed on the assets in our books. Okay, this is a value on the assets in our books, in our record. The fair value is like the value we are actually getting, like actual value, assuming we are to sell it, what we will get. So if we have an asset and we say we'll get 3,000, but meanwhile we can get only 2,000, then it means the asset has been impaired. There's an impairment somewhere. The impairment because this is not the correct value. Okay, but this is a correct value. So this is an what? Impairment. So the standard says when when you are classifying a non-current asset as held for sale and the carrying amount is more than the fair value, the difference is treated as impairment. Okay, to treat the difference. But if the fair value is more than the carrying amount, that one we don't that one there's no problem. If the fair value is more than the carrying amount, no problem with it. We don't calculate any impairment. Everything is fine.
And so in that instance, we will still go ahead to select the lower, isn't
Yes,
it?
yes, we'll still go ahead and select the lower. Yes.
Okay. Okay.
uh We'll still go ahead and select the lower. But in that case, there's no impairment because so impairments usually occurs because what we have stated in our books, we are not going to get it. So here, the current amount is what we have stated in the books, and if we are going to get less than what we have stated, then it's impairment. But if the current amount is three, if the current amount is 2,000, okay, and the fair value is 3,000, so this is what we have stated in the books, and this is what we will get like when we sell. Then it's like a profit to us. It's like
Yes.
we will get even more when we sell. So in that case, we don't even do anything to it. We just maintain the carrying
The
amount.
2,000.
Do you get it? So that is how the dynamics is. Okay, so let's continue. Okay, now the standard says that when you classify an asset as held for sale, you have 1 year to sell it. You have 1 year to sell it. Now, in the course of the period or in the waiting period, the fair value can change. Fair value is the market value, so it can change. It can increase or it can reduce. So anytime there's a change in the fair value, you also have to change the fair value of the asset. So let's say that on 1st January, okay, we decided to sell our assets. Okay, the current amount of the assets at the time of the decision to sell was 6,500. Okay, the fair value of the asset is maybe 4,000. Okay, so the initial recognition, we have to use the 4,000 because we have to pick the lower. Okay, so the initial recognition will be like this. So first, we will have to remove the assets from the current assets. You see, we have to remove this from our records. We have to remove it from current assets to so we have to move it from non-current to current. Ehen. So right now we have to, if this is, so this is PP, non-current. So to move it, we have to credit it. Okay, you have to credit our PP to take it out. Okay. Then we have to debit.
Current asset.
We have to debit our non-current assets held for sale. Let me see. We so let me see something. So we credit. Okay, let me do it properly. Okay, so here we'll have an impairment of 2,500. Okay, this is impairment. Okay, okay, correct. So that's how the double entry will look like. So we'll debit our asset held for sale, asset held for sale. So this will be under what, current assets.
Yeah. Yes.
So we debit it under current assets. Then we'll debit our impairment loss. So this is an impairment, which is an expense. Um, 500. We'll credit our PP because we are taking this out of the so we debit PP by 60. So this will be the new current amount of the assets. This 4,000. This is what will show in our records. 4,000 as at 1st January 2024. Do you get it? Now, let's say we sold the assets maybe October 2024. But in the course of the period, the fair value has been changing. Prices can change. Okay, so during the period, the fair value has increased. So from 4,000, it has increased to 5,000. Okay, so if the fair value has increased to 4,000, 5,000, we have to debit the fair value has increased to 5,000. Okay, so it has increased by how much? Thousand, right?
That's it.
Thousand. So it means the non-current assets held for sale will debit it by thousand. Like we are increasing it. Okay, we are increasing this 4,000 by thousand. Okay. Then when we increase the thousand, we also recognize fair value gain. Okay, because this is a gain to us. Fair value gain of thousand. Okay, this fair value gain will go into our P and L. Okay, do you get it? It go into the P and L. So anytime there's a change in the fair value, we have to adjust the value of the non-current asset held for sale until we sell it. Okay, until we sell it. Okay, so let's look at. Okay, so another important non-current asset held for sale are not depreciated. So
Appreciated.
like we explained earlier, we don't depreciate non-current assets held for sale. However, interest and other expenses attributable to the liabilities of a disposal group classified as held for sale continue to be recognized. Okay, so if there are any expenses as you are waiting to sell the assets, maybe you have to do some maintenance on the assets, like maybe you have to get a security, pay a security to watch over the assets. Those expenses, we still have to recognize them, but it's only depreciation that we will not recognize. But other expenses we, we incur as we wait for a buyer, we still have to recognize those expenses. Okay. Okay. So a disposal, let's look at a disposal group. A disposal group refers to a group of assets to be disposed of. Like an example I gave, a branch. A company has a branch with assets in it. If the company wants to sell the whole branch, the branch becomes a disposal group. Okay, so a disposal group is a group of assets to be sold off by sale. So to be disposed of either by sale or otherwise. So it can be sale, it can be by sale or it can be exchange. The bottom line is we are disposing them. So whatever way we dispose it, that one is up to us. Okay, together as a group. So we are disposing them as a group in a single transaction. Okay, so that's a disposal group. Okay, let's look at an example. On 1st July 2017, Do It All Limited, which prepares financial statements to 31st December, classifies a non-current asset as held for sale. The asset carrying amount on that day is 10,000 cedis, and its fair value less cost to sell is 9,500 cedis. The asset is sold in May 2018. So for 9,400 cedis net of cost. So they declassify it on 1st July 2017 and they sold it in May 20, like that's almost a year, getting to a year.
Yeah, yes, yes.
Okay. So let's continue. Required. Calculate any impairment losses or gains that should be recognized if the asset fair value less cost to sell at 31st December 2017 is I 9,200, II 9,700, III 10,100. In each case, also calculate the gain or loss that should be recognized on the disposal of the asset. Okay, so the 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 requirement is that we should calculate any impairment loss or gains on the assets as at 31st December 2017 if the fair value of the assets is 9,200, 9,700, 10,100. So, like I said, if the asset has not been sold yet, we have to be updating the fair value until we sell it. Ehen.
Yes,
So at 31st December 2017, we had not sold it yet because we sold it the following year. Eh, and these are the fair values, like different scenarios. So assuming the fair value is 9,200, how are we going to how are you going to restate the fair value, the carrying amount of this asset? Okay, so let's look at how we'll go about it. So always we start with the initial recognition, like the the initial transaction. What will be the treatment, the accounting treatment on the date that we classify the assets as held for sale. So we classify the asset as held for sale on um 1st July.
1st July
Uh, s-
2017.
yeah, 1st July 2017. So on that date, uh, so 1st July 2017. On that date, we need to know the carrying amount. That we need to know the fair value less cost to sell. So on that date, we were told the carrying amount
It's 10,000.
was 10,000. Okay, and the fair value less cost to sell is 9,500. So now we have to pick one as the initial carrying amount. So which one are we picking?
The 9,005.
So we'll pick the lower 9,005. So this will be the value of the non-current assets. So on this date, our balance sheet will look like this. In our So this asset will go to current assets.
Yes,
So in our current assets, we should see
for sale.
non-current assets held for sale. uh, and we should see 9,500. Okay, that this is how the initial recognition will look like on the dates of the classification. Okay, now let's go to 31st December, at the end of 31st December, at the end of the year. At the end of the year, the asset is still not sold,
Not sold.
but we need to restate
Fair value.
the fair value. Yeah. So they are so we are let's start with the 9,200. Now the fair value is 9,200. So it means that our double entry will look like this. We will increase. Is that an increase or decrease? So this is
So
9,000.
decrease.
Okay, yeah, 9,200. Okay, so it's a decrease. Okay, so it means that we have to credit the non-current assets because since we are
Decrease.
reducing it, we have to credit it by how much?
Yes.
Is it 200?
200.
Uh-huh. Yeah, we have to a non-current asset held for sale. Okay, and then we have to recognize impairment loss. It means that the asset has lost some value.
Yes.
So this would be like an impairment loss. Okay. So this is the case if the fair value is 9,200.
500. 500.
Yeah, for the first scenario. Now, if
Okay,
the
okay.
if the fair value is the next case 9,700,
700.
so that one is going to be a gain, right?
Yes, sir.
So that one we will credit the non-current assets. We will debit to increase it.
Yes.
We will increase it by how much? So
500.
how much is it? 500. Hey, uh, is it not 300? Let me see. This 9,500 is 200. Oh,
So we are, the current value is now 9,200 at the first scenario. So that is
how?
what we are bringing to against the fair value 9,700.
Okay, I get your point. Okay, so these are distinct scenarios.
Yes, sir.
Uh-huh, so,
Ah, they are distinct scenario. Okay, 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 okay.
so
So it
this,
means we are still applying the 9,500.
so they are
Oh,
just
I see,
saying,
I see, I see.
assuming the fair value is this, the fair value is that. So they are.
Oh, okay. I thought we are carrying over the carrying amount year to year. Oh,
Okay, okay, okay. I get it. The question says that the question has given us like different scenarios. So assuming
yes, sir.
the fair value is like this, how would the calculation be? Assuming the fair,
Mm,
that's what the question
all right, sir.
is trying to. So if the fair value uh, is 9,700, so that would be an increase. So our initial carrying amount is the 9,500. Okay,
Yes,
so this will be an increase of 200 here because we are increasing this to 9,700. So 200. Then this will be like fair value gain. Fair value gain of 200. Okay, so that is the second scenario.
yes,
Let's look at the third scenario. The third scenario, now it has increased to 10,100 and the amount is 9,500. So which is 600.
600.
So we will
We debit
debit
not for sale.
non-current asset held for sale. Yeah, correct. By 600.
600.
Then the fair value
Credit gain.
of 600. Okay, correct. All right, but there's a slight issue with this. Okay, so the standard says that before at the time we classify the assets as held for sale, the carrying amount was how much? Was
Plus
10
10,000.
10,000. Uh-huh. So the standard says that after classifying the asset as held for sale, Any subsequent fair value increase should not exceed the original carrying amount. So if it exceeds the original carrying amount, okay, we will restrict it to the original carrying amount.
Current. Okay,
uh
okay, okay.
Yeah, another way of looking at this is that when we initially classified it as held for sale, we had an impairment loss of, I think, 500, or where is it? The initial, um yeah, the initial initial recognition, there was an impairment of 500, because the carrying amount and the net, and then the fair value, let's go to sell, the difference is 500. So another way to look at it is that after the after the initial recognition, any subsequent fair value gain should not exceed the initial
Original current amount.
impairment loss. That's another way.
Okay, 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 okay.
uh so the initial impairment loss is like the ceiling, that
Yes.
any gains
Lim-
can go.
Limited to it.
Yeah, they get it. So, which means that in this particular case, we have to limit this to 10,000, even though they are
Yes.
saying 10,100, but in our books we have to limit it to 500.
500.
So this will be 500, like this. Yeah. So these are some of the principles we need to. So the bottom line is, after initial recognition, any subsequent impairments, any impairment gain, fair value gain, should be restricted to the original impairment loss. It should not exceed that amount. Yeah. Okay. Now let's look at measurement of assets no longer held for sale. Measurement of assets no longer. You can classify an asset as held for sale, but due to some circumstances, you may not be able to sell it, and now you have to bring it back to, like, its normal status, which is uh, held for use. uh So if you classify an asset as held for sale and you are not able to sell it, and you are bringing it back to held for use, how do we treat it? That is what we are
Hello,
looking.
sir.
Hi.
Sir, okay, so please, before then,
O-
I want to understand this.
Okay.
So, during the period, during the period of health for sale,
Hmm.
just as uh, we said at that time, we shouldn't in depreciation. For tax purposes, is capital allowance granted on it during the period of being held for sale?
Yeah, yeah, that's a good question. Yeah. So, yeah, for capital allowance, yeah, the law says, capital allowance is granted for assets that were put to use during that period of assessment. So if the assets was not used in producing income, then capital allowance will not be granted. That is that. Yeah. So,
So, I
mhm,
asked because of the new subheading you were bringing that reverse from held for sale to. Just I was thinking that
mhm,
if it can happen like that, I was thinking that once we classify as held for sale, there
yeah.
shouldn't be any instance for you to be returned back. If not, maybe businesses will decide to use that as a scheme to be swerving tax or to be they will
Uh-huh.
place it there for some time to avoid some legal liabilities and
Okay.
then reverse it back
Okay.
after everything is over.
Okay.
Or so how do you see? That's why I asked that question.
Yeah, yeah, yeah. You're right. Yeah. That's a very good observation. Yes. yeah, the company can decide to say that okay, we are selling it, but later on, but in terms of capital allowance, it will go against the business if they say they are selling their assets. In that case, they will not get any allowance.
Yeah, 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 yes, yes, it's you are
uh
right.
So
Yes, they
yeah,
will not get. It's true.
so from that angle, it's going to
Oh,
affect.
okay, okay, okay.
It's going
Yes.
to affect them. It's going to affect them. So I'm not sure they want to do that.
Mm-hmm.
Yeah, yeah, that's true. Yeah. Yeah. Okay. So if an asset is held for sale and we are not able to sell it, we have to bring it back to its what's the name? Its former state. So in that case, how do we do? Okay. So the standard says that in that case, we need to find the carrying we still need to find the carrying amount. So the main issue is, I think an example will help us to understand it well. So 1st January, okay, we have classified an asset as held for sale. Now the cost of the asset is maybe 10,000. The useful life is maybe 5 years. Okay, and we have used this asset for 2 years. At the date of the disposal, of reclassification, we have used it for 2 years. Okay, so it means the current amount is going to be
Eight
uh
thousand.
yeah, that will be uh 10,000 divided by, so the annual depreciation is 10,000 over 5, right? So which will
Okay,
give us 2.
60,000.
Hey, wait, so this is, which will give us 2,000.
Yes.
And we have used this for 2 years, so the accumulated
Yes.
depreciation will be 4,000.
4,000.
Yeah, 2,000 times, yeah. So
Minus
the
10,000.
cost is 10,000. The accumulated depreciation is 4,000.
4,000.
So the current amount is six.
6,000.
Correct. Right. Okay. Now we have classified this asset as held for sale. We have not been depreciating it. We have not been depreciating it all the way to maybe maybe 31st December.
Yes.
Mhm. And at 31st December, we realize that, oh, we cannot sell this asset, so let's bring it back to its former state. So what the standards is saying, okay, if you are bringing it back, then calculate the depreciation as if, I mean, you the asset
We're
was not
using
even.
it.
Yes, yes, that's what.
Mm-hmm.
eh. So any the depreciation that we had not charged, we have to charge. So 31st December, every year the depreciation is 2,000. So 31st December, there will be a depreciation of 2,000. So the current amount will be 6,000 minus 2,000.
4,000.
Will be 4,000. So current amount 4,000. Okay, so the standard is saying that, okay, if you decide to send it back, then calculate depreciation as if the asset was never even classified as held for sale. Okay, so we'll get current amount of 4,000. But it is also giving us two um what's the name, two figures to use. So we should use the carrying amount and its recoverable amount, and we should use the lower. Okay, so now the carrying amount is
The fair value as at that time.
yeah, it's also like the fair value, but here is the recoverable amount. So the recoverable amount is similar to the fair value,
Yes.
how much you get from the asset. So if the carrying amount is 4,000 and the recoverable amount is maybe 2,000, mhm, the standard say we should use the lower. Okay, so can you, based on this, why do you think the standard says we should pick the lower and not the normal carrying amount? Because assuming we had not depreciated it, assuming we had not classified this would have been the normal um, carrying amount. Like this 4,000 would be there. But right now it's trying to say we should pick two figures and select the lower.
Okay, so my understanding is that currently on the market, if you are to if when you go back to the market, this is the current prevailing value
Hmm.
of the asset right now. So if you are reversing it back to its original state, as
Hmm.
at that time, use the recoverable, meaning the sellable value at that time,
Okay.
so that you play between probabilities of whether losing or not losing.
Okay.
Eh,
Yeah. Yeah.
And in order not to, because of the current value, sorry, the recoverable the fair value of the, so that we may not end up overstating the asset in the books.
Yeah.
So that
Correct.
reversing it back to a non-current asset, we may not go and overstate it.
Yeah, that's perfect. And that's perfect. Yeah, so the standard wants to ensure that we are careful not to like you said, not to overstate the the current amount when we are restating it in the books again as current assets. So we have to make sure whatever figure we are bringing it back is accurate. So the current amount is
Okay,
4,000.
sir.
Yes.
Sir, can I ask some question?
Okay. Yes, you can. Yeah, you can.
And sir, so you see, with the intention that we want to reinstate it back to held for sale, we are thinking of a depreciation we didn't. That is
Yes.
why we are thinking of reversing it. We are also thinking of calculating all those depreciation we didn't. Okay,
Yes.
that time we heard it, that
Hmm.
period that we heard it,
Hmm.
that consequential revaluation gains and surpluses and the impairment we did calculated, what
Hmm.
happens to them too? Or do
Yeah.
we
Yeah.
leave them just like that?
Yeah. That's yeah. That's also a good observation. Yeah. Yeah. So the those fair value gains and the losses. Yes, that's true. Yeah. So those ones we have to okay. The standard does not talk about how
Okay.
we should deal with those ones. Uh,
That's
the
like I'm going to do my equatorial mind.
yeah, the standard does not talk about how we should. And they're only interested in how to bring it back. uh Is that
Okay,
right?
okay.
uh Yeah, because in fact, those ones it's difficult to go back to make any changes
Mm,
to them. Because they are P&L items, and you know P&L items. When an item goes to P&L, it's like
you
it's
can't
gone.
reverse it again. Yes.
It's going. Yeah,
So
yeah.
in that case,
Mm-hmm.
then this so
Mm-hmm.
we're going back to adjust to get the new carrying amount, like the 2,000 and the 4,000. We're choosing 2,000 as the carrying amount. You see,
Mm-hmm.
before we get the 4,000, we have to adjust the existing carrying amount of 6,000 by depreciation of 2,000 to get a 4,000. Where you are right now. Can
Okay,
you
yeah,
see?
yeah, yeah.
Before we arrive at that 4,000,
Mm-hmm.
as the present carrying value, we use the then existing 6,000 carrying value,
Yes,
and then we applied the depreciation
yes.
to
To
get a
get
4,000. So my focus is on the 2,000. Since, like you just explained, P&L items,
mm-hmm,
it has already been dealt with. This depreciation, how
mm-hmm.
are we going to treat it? Or are we also going to leave it just like that?
Okay, yeah. This,
Or
this
will,
yeah,
uh,
this 2000. Okay, yeah, yeah, yeah. I
because
think.
it's like,
Mhm.
it's a picture it is you. The P&L has already been prepared. Oh.
Yeah.
We are finished. so, so this 2,000.
Where is it going? Yeah, but that's a very good observation. But I think that an example will help us to like
All right.
understand this clearly. So let's use the same example. Okay, so um, we class. So this assets, let's assume we classify this on 1st January as held for sale,
Yes.
and then the fair value. Okay, so at that time, the current value is 6,000, and so
Okay.
and let's say the fair value less cost to sell is maybe 4,500. Okay, so we'll have an impairment of
1,005.
2,500. Hey,
1,000.
is it thousand? Yeah, I think 1,005. Yeah,
1,005.
you're correct. So let's look at the double entry. So we'll come here, debit, credit. Um, we'll recognize non-current asset held for sale, 4,500. Non-current assets, non-current asset held for sale, so 4,500. Then impairment loss. So this will go to P and L. Okay,
Yes. Yes.
1,005. Then the PP, 6,000. So we'll take it off the books. Okay, we take it out of PP. Okay. Okay, now, so this is 1st January. Now on 31st December, we couldn't sell the assets. We and we want to restate it. Okay, so to restate it, we are told we have to find the current amount as if it had not been depreciated, if it had not been held for sale. So we got
Yes.
four 4,000. We got 4,000, and let's say the fair value, the recoverable amount is 2,000. Okay, recoverable amount is 2,000. So there's a recoverable amount, and we had to calculate depreciation charge of 2,000 to arrive at this
4,000. Yes.
4,000. Yeah, correct. Okay, so let's see how our double entry will help us. Sometimes double entry help us to make things clearer. Okay, yeah. So obviously we are using the lower,
Yes. Yes.
and so
2,000.
we'll pick the recoverable amounts. So we'll debit the PP. So right now we are restating the PP by the 2,000. So this would be like the new PPE value.
Carrying.
Uh-huh.
Yes.
Okay. Then we have to de-recognize the held for see this one.
Yes.
We have to take it out. So non-current assets held for sale. is 4,500. Okay. So we have to make sure it balances. Okay.
So please, I'm coming home.
Okay.
So you see, this, why are we do recognizing it against PPE? Because it was still under CA, like current asset. So I was thinking that is where the write-off or the derecognition will happen. Or
Okay. 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 So right now we are reinstating the assets back to PPE. So to restate this back to PPE, we have to recog- recognize this using the recoverable amount for the PPE. And this figure here, since we are taking it out, we have to remove it. This held for sale that we initially recognized here, we have to remove it from current assets. So to do that, we have to credit it to take it off, to take it out of what was the name? Um, we take it out of held for sale. So now we have a difference of, okay. Then we have a depreciation charge. Okay, because we hold on. Okay, since we are using the recoverable amount. Okay, let's see. So 4,500. So the difference is
500.
2,500. Okay. So this one, where would they go? Okay, so let me see. So
So you see, that is why I was saying that.
oh, did I?
You see, so where we are recognizing the 2000 now is under current is under non-current assets.
Mm-hmm,
Meanwhile, this held for sale has been, if you remember, the earlier time when we were classifying it afresh,
mm-hmm.
we have to credit the other part to cancel it completely from the PPE.
Yeah,
So
yeah,
that
yes,
does not exist in the PPE again for
yes.
us to come and recognize it with that 4,500. So I
Okay.
am thinking that
Mm-hmm,
under the CA, under the current asset,
mm-hmm,
where we place them after the recognition. If we want to recognize, I'm thinking
mm-hmm.
we have to perform that computation there under current asset, other than coming to do it under this PPE. So have you seen it? I think that is why it's creating a problem for us because it does
Uh,
not exist under PPE.
yeah, 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 yes. So right now is
Uh-huh.
okay. Okay, so
Yes.
okay, so you mean that? Okay, can you come again? How you were trying to
So I'm,
describe?
so I'm saying that
Mm-hmm.
with you bringing the 2000.
Okay,
The 2000 here under PPE is correct. It's
okay,
understood
yeah,
because
yeah,
we are bringing it back.
yeah.
But that existing 4,500, no. So we are also trying to come and recognize the 4,500 under asset, which I think is not the appropriate way because that 4,500 is no more under PPE. It is being held in current
Current
assets.
assets, yes, yes, yes.
Yes, so if we want to be recognized, I think we have to do the crediting at that place under current asset
Yeah,
and
yes,
not under this.
yeah, yeah, yeah. I
Uh-huh.
get your point. Yeah, yeah, I get
Yes, sir.
it. Yeah, yeah. We have to take it off from to cancel it from.
Yes, from the current asset there,
Yeah, yeah, yeah. I
so
get
that
it.
it will be derecognized from there.
Yeah, exactly, exactly, exactly. So yeah, I get your point. So it should be something like um, we'll, we'll, we'll credit non-current asset by what's the name, 4,500, and then we'll debit, but we need to debit something to. Do you get the idea?
And we debit, you said we need to debit something here at current asset. Sorry, at
Ye-
non-current asset.
Yes,
Do
yes,
you
yes,
mean that?
yes. So yes, so that will be okay. So let me see. Okay, I'm covered. So 2005. So that will be okay. Okay, I'm covered. So okay, okay. Let me let me try something.
Okay, sir.
We are entering into technical zone. Please advance. Okay, let me try something here. Okay, so we are taking this off, and then we are bringing this back. So it will be left with 2,500. Okay, 2,500. Okay, and then okay,
So can we recognize it as impairment and debit it?
that's what. Okay, that's what. Just a moment. Let me. So
Yeah.
2,500. Okay, okay. Let me see something. So credit. Hey, this thing is this is trying to
Mm,
trying to play stubborn. Okay, let me. But we need to find. Okay, so we non-current asset held for sale 4,500. Impairment loss 1,500. So this is 6,000. This is also 6,000. Okay, so 5,000, 6,000. Okay, correct. So now we are bringing it back. Okay. Okay, so PP 2,000. So 6,000. Yeah. So let me see. Okay. I think I've seen the way forward.
Okay, sir.
Yes. What we do is, okay. First, we recognize the PP as the 2,000. What is
All
the
right.
recoverable amount? Okay. Then the depreciation. That depreciation of 2,000 that we we had to calculate as if the asset
Yes,
was
yes,
lost.
yes.
We have to calculate it. Then when we did the carrying amount and the recoverable amount difference, there is also an impairment loss,
Another impairment, yes.
which is the 2,000. You see, which is this.
Mm,
Uh, then the non-current asset held for sale, we have to de-recognize it
yes.
by crediting the non-current asset held for sale. Uh, okay, so this one we'll have to credit it. So it will be left with a balance of 1,005,
Mm,
and this 1,005 is no other than this
the
one.
impairment, yes.
And it should be a reversal. It should be a
Okay.
reversal of the impairment loss we initially recognized. So it's like we are
Mhm.
restating the
Yes.
yeah. So we have to reverse that impairment loss. Yeah. So that's how it should look like.
Oh, okay.
And that's how it should. So situation like this, double entry help us to, to find our way. Help us to find our way out. uh Help us to find our way out. So yeah. I
Okay.
mean, this is a very, technical, question you raised. And corporate reporting, for financial reporting, they may not bring something like this. But for
Mm,
corporate reporting, um, can
I
ask you
see.
to do something like this. Yeah, yeah. So that's how it should look like. Okay, so yeah, so this is how we treat non-current assets no longer held for sale.
All right.
Okay, okay. Let's look at discontinued operations. Discontinued. So a discontinued operation is, it's a component of a business that has stopped operations. So maybe a company has a branch in Ghana, Nigeria, maybe US, and in the course of the year they have stopped their operation in Nigeria. Eh, The
Mm,
Nigeria operation becomes discontinued operation.
okay.
The Nigeria operation, because we have stopped the operation
Using it. Yes.
in that country. So a discontinued operation is a component of an entity that has been disposed of. Either we have disposed of, or we have classified it as held for sale.
Okay.
So either we have classified it as held for sale or we have sold it. And it represents a separate major line of business. So it can be what's the name? A product line, like a separate product line of a business, or it can be a geographical area, maybe Ghana branch, Nigeria branch. Okay, and it's a part of a single coordinated plan to dispose of a separate major line of business or geographical area of operation, or it's a subsidiary acquired exclusively with a view to resale. So you can have a
Mm.
subsidiary which you acquired a subsidiary to sell it. So some companies, big companies buy smaller companies, they groom it, and later
Reset it.
they sell it. So a subsidiary can also, if it has been, if it was purchased with the intention of selling it, it can be a discontinued operation if the company decide to sell the subsidiary.
Mm.
Okay. So the key issue is, how do we report discontinued operation in our books? So that's what we are looking at. So the standard has given us guidelines on how we should treat discontinued operation. Okay. So what we do is, we have to prepare the discontinued operation uh, profit or loss from the beginning of the operation to the end of the operation. Maybe from January to July, or maybe
Okay.
January to the time that they stopped operation.
Operating. Yes.
Yes. So we have to prepare their profit or loss, the post-tax profit or loss of the discontinued operation, and any post-tax gain or loss on the measurement of on the measurement to fair value, let's go to sell, of the disposal group. Okay, so there are two things we have to look out for. One is the normal profit or loss from the time they started operation to the end of the operation, and then also any once we decide to sell it, it will be classified as held for sale,
For sale.
and we have to check for any fair value, uh any what was the name, any gain or loss on disposal. Whenever you sell an asset, you either
It's
make a
profit
gain
on
or
disposal.
yeah, the profit. Yeah, exactly. Uh-huh.
Yes.
So the two components are the profits for the period, and uh, the profit or loss on disposal. Okay, so you need to determine these two figures. And when you determine these two figures, you have to put those figures in the main parent asset. When you put parent asset disposal classified as held for sale. It says
So
that.
I
Mhm.
can't hear your voice keep going and coming.
Oh, okay. Is it better? Is it
It's clear now.
okay? Good. Okay, let's look at presentation of non-current assets held for sale in our books. How should we do the presentation? Okay, so the standard says that all assets held for sale should be classified separately, and we should not mix them up. So even though we know they go in under current assets, like non-current assets
Yes.
held for sale, they go under current, but we have to clearly um, show that these are held for sale items, but we should
Okay.
not mix them with the other assets. The same applies to liabilities. If there are any, a disposal group can be is made up of assets and liabilities. So if you are selling, let's say, a branch, the branch can have assets, it can also have liabilities. So when
Mm.
you are disposing and as a disposal group, it's both assets and liability together.
Okay.
Yeah. So when it comes to the liability side too, you have to also separate the liability separately. The disposal, the held for sale liabilities separately from the other liabilities. Okay.
Okay.
Yeah. And let's look at the presentation. So this is how we are going to do the presentation. Okay. So the P&L. So first of all, you have to report on the continuing operation. So as you see here, continuing operation. Then you also
So
report. Mhm.
now we come to continuing operation, meaning the normal profit and loss. Let me
Uh-huh,
say profit balance or what? Which one is that?
uh-huh.
Ah,
So,
okay, okay, okay. I get you. I get you. So you
the,
can continue.
yeah, the continuing operation are the part of the business which is running. Uh-huh,
Yes, 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 yes,
uh-huh.
yes.
So
Okay.
you report. So that one start from here all the way to here. Then you bring
Mm,
your
okay.
discontinued operation here.
Oh, I see.
Uh, and the discontinued operation is just one line. So you do your calculation, it should be in the notes, like all the income, expenses, whatever you get, then you come and put it here.
Mm,
It's just
okay.
one line item. Uh, so look at how it starts from. So continued operation, revenue, cost of sale, gross profit, blah blah blah. Then profit for the profit for the year from continued operation.
Operation.
Then you
Okay.
put it here. Before we come to discontinued operation. So discontinued operation is it says profit for the period. And so note that this is profit for the year, but this is what profit
Mm,
for the period. It means
profit for
usually the operation is in the middle of the year. Maybe the operation usually ends in the middle of the year, not at the end
yes,
of the year.
yes.
Maybe January to July, January to March. So that's why you see profit for the period. So only one.
It means this is like, for instance, in the case of a whole group of company and then one particular branch
Mhm,
or subsidiary being sold.
mhm.
So in that case, you prepare the entire group's profit as a continuing operation, and
Exactly.
then
Yes.
the discontinued operation is just for the profit of that particular that particular branch or asset being sold profit to the time of operation. Is that it?
Exactly. Yes.
From
Yes.
the time of from the beginning to the very time
Yeah. They stopped
they ceased
operation.
operation.
Yes. Yes.
Ah, so okay, 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 okay.
uh So if you take the profit, if you take the profit or loss account, you can clearly see the profit or loss we made from the discontinued operation. We
Mm,
compare this with the continuing operations. Uh, then we have the profit for the year. So the profit for the year is the continuing operation plus
profit
the
plus the
discontinued.
continue.
Yes. Then if you
Okay,
have.
so
Mhm.
in case the discontinuation gives a loss, it means you are going to less it
Yeah, if it's a loss, then you less it. Yes.
from the continuing operation profit.
Exactly. Yes. If it's a loss, you will less it from the continued operation profit. Then if you have other comprehensive income, then you bring it here. Then we have total comprehensive income for the year. Then you bring it here.
That's what the comprehensive income, in case
Hmm.
uh, it's coming from the discontinued operation, like the help for say the one we are doing now, calculating revaluation gains.
Yes, 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 yes.
Even though we are discontinuing it or we have disposed it, can we
Hmm.
still continue to help the comprehensive income related to it and the
Yeah, yeah,
comprehensive
yeah,
income?
yeah. That's also a very good question. So the other comprehensive income will have to be added to this to other comprehensive income for the year. So that this one is made up of both the continuing
Uh,
operation and the
and
discontinued operation.
okay,
Do you get it? But
yes.
you can decide to separate it. I mean, if you want to. You can
Oh,
do a note here. So a note here. Then in the notes you show the breakdown of the continuing operation, other comprehensive income.
say
Mhm.
so please pardon me. Say that so pardon me for the many questions, but
Oh,
I
it
beg
is
you.
good.
So you know it's my first time doing this. Oh.
Oh wow! And but you show a lot of understanding of the subject matter.
Like
So
I have passed FR about 10 years ago. I
oh,
stopped I stopped for
ah
let me say some 7 years and I want to continue with it.
oh okay.
So many things I've forgotten. But with this particular standard like this, I didn't do it deeper like we are doing today.
Oh okay. Oh I see.
So I beg you, you see the profit for the period
Yeah, from yeah.
from discontinued operation,
Yes, yes,
the
yes,
127.
yes, yes. Yeah.
So please can you hear me?
Yeah, I can hear you now. Yes.
So I'm saying that
Hmm.
you see the profit for the period from discontinued operation, the 127.
Yes, yes. Yeah, I can see.
What does it entail? Because I was thinking that it entails revaluation gains and and all other profit from the discontinuation in case it was held for sale and now was now sold. Maybe profit on loss on or profit on disposal,
Yes.
revaluation gain, or I thought all are inside.
Okay, okay, okay. So yes. Okay, so let's look at the components of that this 127. So the
Okay,
standard says this component is made up of the post-tax profit or loss from discontinued operation. That's one. Then another, and the
okay.
post-tax gain or loss recognized on the measurement to fair value less cost to sell, or okay, so post-tax gain or loss on the measurement of fair value less cost to sell, or on the disposal of the assets or disposal group representing the continued operation. So it's made up of two main items. The one is the normal
Mm,
profit, like
profit,
income and expenses, and also if there's any fair value gain,
gain or loss
yeah, fair value gain or loss. It says post-tax gain or loss recognized on the measurement to fair value,
of the fair value.
let's go to sell on the disposal, or if there's any uh, what's the name, profit or loss on disposal, you also include it. So I think with this, I think I have a question, and I think
Okay,
let me look for that will help us to understand it very well. International international. Okay, okay. Let's look at this example. Okay, let's look at this. It says this illustration is based upon implementation guidance provided with
in
IFRS
fact.
5. Okay. Okay, it said a company discontinued an operation during the year to 31st March 2018 and sold the corresponding disposal group. The revenue and expenses of the discontinued operation for the year to 31st March 2018 were as follows. Okay, so this is the operation like for
Yes.
that period. So revenue, expenses, pre-tax profits, then tax expense, post-tax profit 111. Okay, let's continue. The fair value of the disposal group when it was initially classified as held for sale was in excess of its carrying amount. Okay, so there was no impairment loss at that time. So the fair value was more than the carrying amount. So there was
Yes.
no impairment. Okay. A pre-tax gain of £20,000 arose when the disposal group was sold. So when they sold
The
the
unit.
the unit, yes, they made a pre-tax gain of 20,000, like profit before tax. Okay,
Yes.
and then later they pay tax of
1,000.
4,000. Okay, so now let's look at the the whole profits that we should include in the main financial statement.
Okay.
So that will be the normal operation, which is the 111.
Mm,
Yeah, 111. Okay, and then the pre-tax profits, which is the on the disposal, which is the
which
20,000.
is
Then we would take out the
tax.
tax,
Yes.
which will give out the 127.
Yes.
The 127 that we saw. So when you
Yes.
get this,
Yes. Yes.
uh, when you get this 127, then you come and show it in the in your main P&L,
Ah,
like this.
so
So you do the
it
working.
means
Mhm,
it means the 127 as we are seeing there,
mhm.
even the profit from continuing operation is inside,
Yes, yes, yes. Everything is inside. So it's a
which
package.
is the 111 we saw there.
Yes. Uh-huh. So
Ah,
it's one figure, but it's made up of other figures.
about three items.
You see. So
Okay, 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 okay.
in the notes, you show how you arrived at that 127.
Mm,
You see. Yeah.
okay, okay, okay.
That's how the
So
presentation.
me,
Mm-hmm.
my assumption was that
Mm-hmm.
the the 111 stands on its own separately, and then the 127 also come as a result of, you see, the 20,000 realized the
Okay.
20,000 will start, no, is it
Yeah.
this 20,000 that we realized the tax from her, the pre-tax gain arose when disposal came. No? I was thinking
Mhm.
the 127 entails this one alone. No?
Ah, oh,
Yeah, I
okay.
was thinking it's only entailing, containing the gain from the disposal alone.
Ah, okay, 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 okay. No, no, no.
So not knowing
Yeah.
the actual period profit for the continuing operation is also included.
Yes, it's also included. Yes. So it's a single item, line item
Oh, okay.
with all the yeah, all those figures.
Mm,
Then yeah,
I see.
yeah. So it's interesting. You can see it's very interesting. You know, it's interesting. Yeah. So that is it.
Right. Okay.
It's an interesting topic. A standard.
Mm.
Yeah. But you can see that it's also not difficult. It's quite straightforward.
Oh, yes, it's not difficult.
Uh-huh.
It's not difficult. It's straightforward.
Yeah, it's straightforward. So you just have to only know the principles, and once you know,
Yes.
you are good to go. Yeah, you are good to
Mm.
go. All right, Eben. So
You
This is
say,
where time will permit us.
all right, say.
Yeah, so God willing, tomorrow. So the CR lecturer says he'll be available Tuesday and Thursday so that you cover the ones you missed. But you can always join the FR too. Since CR and FR, the only difference is there are only few differences. Yeah,
So,
so
so does it mean the CRT timetable is going to be Thursday and the Tuesday?
oh no, it's for only. He said this week and next week. I think he's occupied within these two. Uh,
And then afterwards we'll be doing it in the
Normal, yes, the normal timetable. That's yeah, the normal period in the timetable.
because I
Uh,
have other class, especially even on the Thursday.
oh,
Um,
okay. Then if
I
that's the
have
case, we can communicate so that he can change it for you to a suitable period. That
and
will
so,
be
so that's why I'm asking if only it was just going to be once. Because
ah yeah.
that one will not start next week, Thursday. It will start
Ah,
the following.
oh, okay, okay,
It,
okay, okay.
it will begin in the following week.
Oh,
So
okay.
if after next week it will not continue there, then
Ah,
it will be
yeah.
okay.
Okay. Oh, okay. Then that's my yes, yes. It's okay. It's
So,
okay.
so and I beg you, so you will post this one on the group, right? The lecture notes so that I can still go
Okay.
through and then
Yes, yes. I'll yeah. I'll
you share the working ball too.
the yes. I will share with you. Yes, the workings we've done. Let me save it.
And say, I beg you, can I also have access to the previous videos, the other standards you have done prior
Uh
to my coming, so
okay.
that I
Yeah.
can still go and catch up.
Okay. Yes. Sure. Sure. I have them.
And
So
together with the slides too, I
the
beg you.
slides. Okay. Sure. Sure.
Uh,
Sure. Yeah. I'll forward them to you so that at least as you are waiting, you can
all right, sir.
also you can also
Good.
look. I like your enthusiasm to to kill the people once and for all. Yeah, it's good.
So you see, I'm left with CR and corporate.
Ah,
No, I'm left with CR and
strategic.
how do you call
Oh,
it? Strategy.
oh, then you
Then I'm
almost
done. So I just want to,
yeah, yeah.
I want to kill it at once.
You are right. Yeah, you are right. See, once you if you are not done, you are. It's like they're still bending on you. Once you clear it,
Mm,
then
mm.
the burden is gone. Yeah, so you have
I
to.
said, you know, I'm in a particular village view at Water region
Oh, really?
around uh,
Oh,
around
wow.
Pando area. There is a village they call the Vapo.
Oh, wow.
I'm working in the court.
Oh, so you were posted there, like, or
Yes, I was posted here 2020,
what?
and because of network issues, I couldn't, and
Ah,
traveling issues, I couldn't because you will not find any CA class here again. So
ah,
I pulled it up for some time. Even
oh,
I was even planning not to continue again.
oh. Meanwhile, you were so close to, I mean, finishing.
Uh,
Oh, wow, 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 wow.
so this time I just want to force myself and do away with it.
Yeah, yeah, that's true. So that
Mm.
we'll come for your graduation.
Yes,
You come for your graduation.
yes,
Oh,
sir.
that's good. Okay. All right.
All right, sir. You. Thank
Okay.
you.
Okay, you're welcome.
You.
Yeah. Yeah.
You.
Bye.
Bye.